you say we're on hold, but does that also include December? Because that's not what Stuart Paul just told us. He thought maybe making for, a smooth transition to the next Fed chair would call for maybe a cut.
Absolutely, and good morning. No, high conviction here that they go ahead in December. I thought the whole hawkish narrative from the Fed a week or two ago was a little bit silly, given the situation that we're witnessing in the labor market figures. Whilst they argue that they're kind of flying blind without enough official government data, what we've been seeing is private level data such as the ADP figures and a few other surveys suggest that the weakness in the employment situation for the US continues. And whilst the Federal Reserve has an inflation target and we're still too uncomfortably near 3% rather than 2%, the labor market always trumps the inflation data, and I can see the problem getting worse. And from the NFP that we saw last week, the unemployment rate rising, even though it's stale data, confirms the trend that was already in place. So for us, it's a high conviction December goes ahead. It's just that in Q1 and Q2, we do expect the growth figures to come in pretty strong for the US. You've got fiscal stimulus helping that with the One Big Beautiful Bill, but also globally, you're seeing credit expansion and fiscal stimulus in Europe, for example, and now Japan. And then you've had the monetary easing from the Fed and other central banks. So it's really hard to say we've got a recession in Q1 and Q2 next year. And it might be the case that we see less Fed cuts than what's priced. But once the new Fed chair comes in, Bonnie, it is open season for the new Fed chair. If they really want to push us pointing towards the weakness in the labor market for the direction of rates, there's an argument that they can go further.
But Jordan, so we know that this is a strange labour market. The Fed chair himself has said that it's a curious dynamic that we're seeing because supply is down as well as demand. So do we read the unemployment rate the same way as we would have done, say, last year or the year before? And does that continue into next year? So do we have to sort of, make adjustments to our view of the labour market because of all of that?
I think it's a cycle like no other. We're talking, as you say, about the lower immigration figures making non-farm payrolls numbers harder to digest because we're used to seeing the growth rates, 100,000 each month being the sort of break-even point for unemployment. But now that's much lower thanks to lower immigration, and estimates vary between 35,000 to 50,000. Anything above that, the unemployment rate might not go up. But we're seeing as well the implementation of AI constantly every morning. I look at my Bloomberg and there's another story about another firm laying off workers or reducing hiring, and there's always quoting AI in those stories. And I think that this could be a cycle like no other. What we have seen is the youth unemployment rate in the US has spiked significantly higher, and we've never had a cycle where unemployment rates go up for the youth faster than the rest of the economy. It's something that's quite different for this cycle. So I do worry that we do have this immigration story, but we also have an AI sort of angle to it that we might not have seen before. So I think the Fed will worry about that more than inflation, where I'm not too worried about inflation either. The pass-through of tariffs hasn't been that strong as expected, and the housing sector's slowing down. I actually think Stephen Myron's got a good point.
Okay, so how much lower can rates go then without igniting troublesome inflation again?
Well, the market has typically bounced off 3%. If you look at the US one-year pricing for where the Federal Reserve could get to in a year's time, usually when we get to 3%, that's the sort of anchor point for when the US economy starts to rebound. And that's why US rates have been so range-bound for about 2 to 3 years now, because every time we've got a very dovish market and we've got down to 3%, then all the data surprises accelerate, because that's usually the level where the US consumer comes back in and industries rehire. But consider the situation that we're in now. We've been around 3% for some time now, and still the labor market is weakening. So we might start to see that push to 275, 250. We're expressing that with Z5, Z6 flatteners in the SOFR curve. We do think that the market will toy this new Fed chair, teasing with the idea of lowering the dots for the neutral rate assumption for the Fed, which is currently at 3, which is why it's been that anchor.
Lowering them to 2.5, 275?
It will happen in stages. So in 2024, the neutral rate wasn't at 3% in the dots as it is today. It was slightly lower, around 2.6, 2.7, and they raised it up by 10 to 20 basis points sequentially at each update of the dot plot. So I think we could see something like that play out in the second half of next year.
I have to ask you about Chancellor Rachel Reeves. She is going to be taking the podium in less than 2 hours now with her budget. Of course, Liz Truss is always in the background here, and that's what Van Ram pointed out to us earlier, that she has to make sure that this entrenchment of the risk premium in the gilt market goes away, that it stops being entrenched. Can she do that today, Jordan?
Indeed, today is the only time an MP is allowed to have a glass of alcohol in the House of Commons. I think it's been a while since a Chancellor has taken the opportunity to have a whiskey, and I don't think Rachel Reeves is going to be reaching for the champagne. When it comes to today, I think a lot of the sort of budget sort of big movers have been leaked already, such as the VAT cut on energy not happening, the income tax hike on everybody not happening. So it's going to be a smorgasbord of lots of various different measures of raising taxes on capital and hopefully less mobile forms of income, so-called wealth taxes. So raising property taxes by council tax is one way they aim to do this. I think the market's looking for a fiscal headroom number of 15 to 20 billion. That's nearly double what it was at the last budget, because what's been happening is she's been giving herself such little leeway on the fiscal headroom. This is the amount of money she has to play with before she breaks her fiscal rules. And that leeway has been historically very small. So you just get small sell-offs in the gilt market or big moves elsewhere. And that leads to her having to come back in 6 months' time and raise taxes again. So yes, if the number's smaller than 15 to 20, expect a gilt sell-off, because that means that she'll have to probably come back to the market in 6 months' time. But I think she's very much aware of that. She's learned her lessons from it, and her aim today will be to try to get positive headlines, either politically or via the financial markets. Yeah. It feels very consensus, though. I do feel like the market's going into this long gilts, but that's the way we'd like to position it as well.